Hi everyone, welcome to our presentation. Here we will be giving advice on which precious metals could be the best to invest in depending on the user's needs, and whether in some cases precious metals are good to invest in at all. So there are two types of metals, precious and non-precious. Precious metals are usually more valuable than non-precious metals, and this is because of their rarity, how they're made and found, and their historical roles. Here we've selected the most common precious metals amongst investors: gold, silver, platinum, and palladium. Our selected economic indicators are also inflation, interest rates, and GDP growth. So to offer advice, we've analysed short and long-term precious metal prices predictions using historical data from 1990 to 2023. Also, economic indicators that we've included are inflation, Bank of England interest rates, and GDP, as these are crucial for predicting future precious metal prices. So we focused on giving advice based on potential investor profiles. So we've given our advice in terms of short-term and long-term investments, as well as high-risk and low-risk investments.
So based on our external research and economic theory, here are some general relationships between economic indicators and precious metal prices. Inflation generally has a positive correlation with gold prices due to its status as an inflation hedge. We also expect inflation to have a positive correlation with silver prices, as we expect gold and silver to be coupled. Interest rates tend to affect all precious metals, and a high interest rate causes lower prices as other assets are made more competitive. Low GDP causes higher prices in precious metals over time, as these tend to recover much faster than other assets. Now let's look at the current situation affecting the UK. The UK is currently in an unstable time period where there is stagflation, which is high inflation and low GDP. There's a cost of living crisis caused by high energy prices, and there's an unstable government. We've had 4 prime ministers in 4 years. All of these have had a huge negative impact on the consumer and business confidence. So with the UK being in an unstable period now, we think precious metal prices might deviate from the expected patterns we explained previously. But in the longer term future, the market tends to even out, so we think metal prices will follow the expected trends outlined later. Now let's start looking at the short term. We've defined this from 1 to 36 months. So from our correlation calculations, we can see that in 1990, unexpected weak correlations between gold, inflation, and interest rates may be explained by the UK joining the European exchange rate mechanism in 1990 and a recession in 1991. The UK economy later stabilised in 1993. The 2008 financial crisis caused a plummet in GDP, as well as a shock in the precious metal market, among others. The Bank of England responded by cutting interest rates from around 5% to record lows of 0.5%, resulting in strong correlations among metals, interest rates, and GDP. In 2022, high inflation forced the Bank of England into increasing interest rates, causing strong negative correlations between metal prices and interest rates, and influencing the weaker correlations between metals and inflation in 2023. Notably, the rapid rise in energy prices in 2022, which had an index of 152, compared to expected 2023 prices with an index of 112, these are all against a base of 100 in 2010, goes some way to explaining this high inflation. From our previous analysis, we can see that for all the years with extreme economic events, there was a very good opportunity for high return on investments in the short term, but this also comes with extremely high risk. Given that we're in uncertain times now, we expect similar opportunities to arise. So in general, a higher volatility means a higher risk, as it's more likely that the price of an asset will move unexpectedly, which could lead to both larger gains and larger losses. From our correlations and now our volatility analysis, we can see that in general, gold has a lower volatility and therefore a lower risk during unstable periods than other metals. This suggests that gold is the safer of the 4. However, it is still high risk and subject to investor confidence and market conditions in the short term. Out of the 4, palladium demonstrates the highest opportunity for short-term gains. However, it is also very volatile, so associated with the highest risk. This is followed by platinum as the second most volatile. Our advice: for investors interested in a high short-term return and are also happy taking on high risk, we would recommend a larger palladium or platinum allocation. So as discussed previously, The precious metal market is quite volatile in the short term. This makes short-term investment in precious metals risky, and a potential investor who is looking for more guaranteed gains is better off investing in other avenues. For example, gilts and saving accounts are other options where initial investment is guaranteed. Gilts and government bonds are where an individual lends to the government for a fixed interest rate. Their initial investment is returned in full. Our advice for investors looking for more guaranteed gains, we recommend investing in standard gilts or a savings account over precious metals. I'll now pass on to Charu, who will talk about long-term investments.
Now let's look at long-term investments, which we have defined as more than 3 years. In long-term investments, generally speaking, volatility becomes less relevant as the assets have time to ride the peaks and troughs of the market, making it less risky to invest over a large period of time versus a short period of time. So when analyzing the best asset to invest in over the long term, we are focusing more on potential returns, and these returns can be affected by economic indicators. As we have already seen with our previous volatility calculation, gold is least volatile asset during period of economic uncertainty. However, when looking at the volatility of the metals from 1990 to 2023, we see that silver has the lowest volatility overall, while platinum and palladium has the highest overall volatility. This means that gold and silver are two of the least risky investments and have most stable returns. However, this also means that they can result in much lower returns. This confirmed by our forecast. If a user invests 1,000 for 10 years, it would yield the lowest return from gold, followed by silver. In contrast, platinum and palladium offer highest returns. To compare this similar market, we looked at FTSE 100, which increased by 23% in the last 10 years, whereas gold prices increased around 50%, suggesting potential for higher long-term returns with gold investment. We recommend people interested in long-term investments to consider all precious metals, and if you're open to higher risk, we recommend more of your investment to be allocated to palladium and platinum. For lower risk, we recommend more of your investment to be allocated gold and silver. However, note that gold acts as an inflation hedge and safe haven, unlike other metals affected by technology changes. So for investors looking for very low risk, long-term gilts are available, though they have much lower returns as discussed before. Let's dive into some key points for solid overall investment strategy. So here's the breakdown. For long-term investment, consider diversifying your portfolio with all precious metals, and it's a smart move for stability and potential growth. And don't forget to mix in those low-risk assets as we chatted about. If you're feeling a bit adventurous, allocate a higher proportion to palladium and platinum. It adds a bit of a spice to your portfolio. And if you're all about balance and lower risk, lean towards gold and silver. They're especially good for long-term gain. If I highlight gold, it's just not the metal. It's the reliable inflation hedge and a safe haven investment, a true all-star in your lineup. For super cautious, explore very low-risk option with long-term gilts, and hey, there are always short-term saving bonds for a quick financial boost. Remember, your investment strategy is like a tailored suit. Make it fit your risk appetite and financial goals. We are here to help you tailor it for a prosperous financial future.